this over just so I can read chat. Alright, so before we even continue, there's one basic thing I want to start with when it comes to day trading, and a lot of people don't show up to the table with a plan. Note, that doesn't mean you need to have a bias. So what I mean by that is showing up to a session and being bullish versus bearish. You don't need to have that kind of idea on the back of your mind. All you need to know is relative liquidity, and then knowing where stocks can trade in a positive or a negative manner. And so what I mean by that is, for example, I'm going to use NASDAQ to kind of start with a basic. Also, good morning, big dog, or good afternoon.
Hey, baby. Sorry, you can hear the Blue Jays.
Yeah, I can hear the Blue Jays.
How you doing, baby?
I'm doing good. I'm excited for Monday.
Okay. Hello, everyone.
Oh, what's good, Israel? So, what I mean by starting with a plan, for example, again, doesn't have to mean you're bullish versus bearish, but I use this pre-market range every morning at 8 a.m. to kind of understand whether or not I'm feeling bullish, bearish, or why, depending on where assets are trading at. And I do this on any stock with any major liquidity. And so I'll just drag over my Discord in the recording so you guys can see it. So, you know, I'll always put out Apple, AMD, Amazon, Disney, this list every single morning. So I'm prepared to trade those just in case I feel like it. And then from there, so we've identified on this example the liquidity on NASDAQ to the upside, and then the liquidity on NASDAQ to the downside. Are you recording this? Yes, I am recording. So we've identified this liquidity. This doesn't mean necessarily as well that I'm immediately taking calls or immediately taking puts in between these levels. However, when I see that these levels are therefore then respected, claimed, so on and so forth, that's where I'm looking to kind of take an edge and why. I'm going to go through multiple examples, and I'm going to go on and continue with the other tools I use. But for example, NASDAQ on the open on Friday, it tried to dance between our two signals, came back down due to some news that came in. We found a daily fib set, and note, I'll continue with that idea in a second. I just want to go over this specifically. Market opens, we get a strong bid and push to the upside. We get this push. The short signals are rejected, so we come back down and we make some form of a base. We can also identify with fibs based off of our plan in the morning. That if this zone and or this zone is held, we're holding bullish support. Volume comes in off the pivot and bears step away. You can see in this last exhaustion tick right here, and I'll highlight it with this arrow, that bears tried to break over and continue, but we had buyers show up at the bottom of the price, and from there we used it as a bullish support and we took off. So I may either take calls down here in this pivot, and or I may take calls through the long signals and or through our short signals, and these are valid all day long, every single day. However, I will add different levels throughout the session and throughout each individual session to therefore identify whether I want to be short or long and why. So this is an example with NASDAQ, and I'm going to use Apple's Friday session as an example as well, because it was very easy to identify. So we have our two pivots. I'm going to mark this one at the bottom as well, and then I'm not really going to mark this other one in yellow, but I'll do it just for the recording. If the ranges, since we're trading options, are within like a 15-cent range like this is, realistically I won't change it. But we have our two pivots we've identified. Bulls again flush below, they held daily demand here off this 144 price. We come back up, dance along the first short signal, reclaim it, wicky but explosive price action, come through the second one, break out through the long signal, back test the short signal momentum and held, and then from there we broke out. And this is a very, very, very easy long in my opinion. So we want at least a 3-to-1 risk reward ratio. So we're gonna identify it here, and this is actually an even better risk to reward ratio than 3 to 1. Hypothetically, let's say you caught this whole move, it's actually a 6 to 1 risk ratio. So this is a very, very, very positive trade if you took it. We were long throughout this pivot, so we caught the second redep rather than the first one. But pretty easy overall. So every single morning, no matter what stock, I'll always come up with a plan. No, that doesn't mean I'm looking for market bias. I just want to identify where major levels of intraday liquidity can be identified and why. And so from there, even if you missed the long signal once, when we came back and we back tested it inside this range right here, we came in, we saw buyers step in, volume weighted average, bears try to break it over. And you could also see if I mark the volume like this, you could see the relative size doesn't increase in comparison to the prior buying up here. So bears are quickly exhausted out and we shoot up in a parabolic motion. So this is one of the tools that I'll use every morning while I'm day trading. The second one, and I've talked about this a lot recently, is tick. This has become one of my new most favorite tools to use. This tool is very, very, very strong if you don't use it. However, if you are day trading with tick, I wouldn't use tick for things like Amazon. Well, no, not Amazon. That's a bad example. I wouldn't use tick for very individually specific stocks like MU, FSLR, uh, TSM, things like that. Even though they do tick with the general market, sometimes growth stocks and other companies behave in a way to where they don't follow the general market's natural behaviors. So you want to use tick in relation to things that are within the New York Stock Exchange and move alongside each other. So the best bias that are, or best example of this would be SPY, Apple, NASDAQ, Amazon, so on and so forth. You know, the very big and popular names, and have major liquidity too. Also AMD, but more so the first couple ones I stated. From there, if you are using TradingView and you aren't subscribed to the package already, subscribe to the ARCA package. You can find it here under the top left, and then accounts and billing. And then from there, you can see the extra data packages. It is, I think, $4 a month, but it'll give you the 8 a.m. candles that I showed along with these wicks on tick. And now I want to share these side by side so you can really get an idea of how the market can trade. So for example, I'm going to call this a priced in down movement. Why am I calling this a priced in down movement? Well, we have a wick with buyers that came into the market. However, there wasn't enough liquidity to bring down the market, and so therefore price shot up. However, we know that there's a quote unquote priced in down move within this uptrend on indexes, right? And I want to make it very clear as well that just because there is a priced in down move doesn't mean you buy it immediately, and it doesn't mean you short it immediately. However, I want to show you side by side so we can kind of get an idea of when to short, right? So we see this price in down movement, and if you observe how tick is trading within the highs and lows of the ranges, you can see that overbought scenarios are in positive 1,000, oversold or heavy selling scenarios are in negative 1,000. Anything beyond that point is extreme buying or extreme selling. And since we're using NYSE tick, we're observing the general New York Stock Exchange. And so from there, we compare the most recent resistance in relation to the New York Stock Exchange's buying levels to further price action. And so what I mean by that is if we look at the highs of tick here, at the last time we got up in this range was 800, 07, 789, 783, so on and so forth. We come down, we get a price and move, negative 37. So now it's a neutral sell signal, but it's a sell signal regardless that showed up. So we notice within this uptrend, price never got to a period where it was slowing down. And what I mean by that is every single high within these ticks is trading at 800, right? 847, 857, 897. So if we compare it in the background with indexes, right? If we look at indexes, and this comes in at 215, this sell signal, right? So we look at 215 on SPY, and this entire time we didn't have enough bear volume to help identify the short signal coming down at the end of the day. Well, what's another way we can use this to understand how it can come down and why it can come down? Well, if we also look at our volume before we even continue, we notice that this bear volume at the bottom is pretty relative. It doesn't really change trend at all. However, we can identify that if we observe here on the left side, the last time we had major selling roughly and where bear volume started to ramp up was at 1220. So now let's observe where tick was at 1220, and maybe we can get a better idea of what we need in order to have our better sell signal, right? So tick on the 1, 3, and let's go to the 5 minutes, make it easier. So roughly at 1220, we had tick trading in the upper 500s. Well, that doesn't really help us. We have a priced in down move, and the last time we found resistances was in the 900s, 800s, so on and so forth. However, when we compare it with SPY, we have wiki price action in comparison to where the short signal came in. Remember, the short signal came in up here. So what can we use alongside this to help understand, okay, maybe we can come down at the end of the session, and I can show multiple examples of this throughout the live session to so you guys can better understand this. For the people in the video and for the people in the chat, I'll be live in voice chat Tuesday through Friday this week. Monday, I won't be able to watch the session as aggressively, but the rest of the session, I'll be able to show you guys live examples of this. But there are a lot of times where tick will leave in these price-in moves, and then from there we can use these general ranges of buying and heavy buying and overbought scenarios to the point where last time tick gets up here in these 900 clusters, so you can see on the top right of the chart, it says opening 853, high 941. As we continue with indexes, we never see continuation beyond that point. Every single time we got into the overbought scenarios on tick, so the past buying was trading at 700, 792, at 836, at 899, so on and so forth. While we're ripping up in price on the background, if we ever get to a point where the buy signal on tick then overvalues what the previous resistances were on tick, we can therefore say, okay, maybe these buyers are too overbought here. Maybe price can slow down. Let me look for a topping formation. And around the same time that 941 tick came in on tick, it's this red candle right here. And from there, people likely started building a short position. You can see how it started to trade, boom, 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 finally come down. And then from there, we can say, all right, a short signal was then cleared and filled because of the fact that the wick got fully filled by tick and left. If it leaves this weird gap kind of formation, we don't like it, and that's why price kind of came down and closed within this range at the end of the day. There wasn't enough volume to continue pushing us, and you could see the heavy short selling that came in into the markets especially. But this is a very, very, very good tool to use. I wouldn't recommend using this at the end of the day because you can get pretty crazy wicks, for example here, and you don't really get a lot of confirmed movement at all. This is something I would use throughout the day, especially in the first 15 minutes to 2 hours of the session. It can provide some generally very, very strong signals that might otherwise be missed within the markets. So let's use another example from Friday. So I'm going to scroll a little bit left on NASDAQ or on SPY. So we're ripping up here, and we can notice that the prior close, the buying was trading at roughly 790. Well, we start breaking into the positives here on tick, and we are failing to even hold the prior close of buying. So price comes down, and we come down to a place where we have to be more liquid because these buyers that are present here aren't as strong as they needed it to be to continue pushing it past Friday's close. So from there, we come back down. And if we understand the lows of this selling was in the negative 400s. So we boom, 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 we start selling negative 800, negative 1,000. And from here, let's do the opposite. So on this candle, we put in a priced up move, right? So we can see that tick leaves a wick up, and then we come back down to go grab liquidity. And again, I want to make it very clear, sometimes price won't be at the same range of these long and short signals. So you have to not, you can't just use this, you have to use other things like volume, price action, where price is, so on and so forth. But we dance for a second, and if we remembered where tick is basing at, it's at the negative 1040s, 1050s. We get a priced in long move, and look where liquidity goes. It goes into these negative 800 ranges. However, the New York Stock Exchange is showing us that, hey, there are buyers present here. You can see it by that former wiki price action regardless. Those buyers step in, and then you see that long signal up here get taken out and filled to the upside here. And then to have further continuation and to further support the trade that you're in to the upside and to break these buyers out, you need tick to continue breaking over the prior buying. And that's why we get an explosive move up here. We start ripping into the positive 600s. Remember, up in this range, we never even got into the 500s. So you see some tight consolidation. You see a fake short move come into the market. Tick barely trades into the negative 200s. The prior selling was at negative 450. So we already know that looking at this, we can possibly see an explosive move up because those sellers aren't as valid as they were beforehand. And sure enough, we get a very large boom candle in the markets and we break daily resistances. And regardless of whether or not you even use tick, so this might be too complicated for some people, right? If you were using the prior methods and you understood, okay, well, our short signal for the day is down here within the markets, and we come down and we reclaim that short signal, along with the fact that tick also had a fake sell signal and back tested the pivot. There's two beautiful methods of confirmation that help you take a long and break out that pivot high. And this is another one that I'm going to talk about. A lot of people, in my opinion, don't use this enough and need to use it more. And this one's very, 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 very simple analysis. There are days that this won't serve you justice and you need to use other tools. And everything I'm showing you should all be used in conjunction. And it takes some practice using them in conjunction, but it's a general reminder to always use multiple tools and things to guide you, not just one. But the next thing I wanted to talk about was volume. Volume is one of the best tools in the market, in my opinion. It's an unbiased tool. It shows you average buyers and sellers, and you have to understand within price that this will very, very clearly, in my opinion, show you whether or not something is more validated or not. So I want to give an example of SPY again. So I'm going to mark, there's general long and short signals. I'm not going to mark all of them, just going to mark the major ones. So these two yellow ranges are long and short signals. And then from there, I want you to notice what happens within volume. So as we get to this price, can we consider this a bullish anomaly? Me personally, I think we can. And why is that? Well, we have very, very large volume, considerably the largest volume of the session come into the market as we're testing these pivots. We then break above those pivots. However, you don't see, if you look at the weighted average on the bottom, you don't see continued volume coming into the market. And so from there, price comes back down and back tests it. However, this is something to make note of. You can notice that the short volume that came in is also a short anomaly due to the fact that even though it is higher than the previous selling, you notice that it's not higher than the previous buying. Super easy, and it's not overcomplicated. And so from there, price gets shot back up and bears try again. However, regardless of even this prior selling, if you look down here where I just marked in relation to the previous selling, you can tell that sellers are weaker as price then broke back above into this pivot. And so bear said, okay, we tried shorting here in the 389s, it failed, came back in, we tried to reshort one more time, it failed, and a bull said, hey, wait a second, these bears look kind of dumb down here. You could see that the volume at the bottom came in comparison to the previous buying and then pushed us over. And so therefore we put another topping pattern, and bears tried stepping in one more time, but something that's worthy to note for this drop, and we get a pretty steep drop going into the middle of the session. It's around 3 points, which is a pretty decent chunk for options. Um, you can notice that while we're continuing, and you notice this bullish anomaly to begin with as we get into these highs, but you notice that the bears are continuously trying. And so eventually at one point you can see a possible big move down. Is volume anomaly best viewed on 1 minute chart? Does it work equally well on 5 minute or higher time frames? Yes, yes, and yes. If you're using intraday, I would prefer you use 1 minute. The only reason, just for volume specifically, the reason why is I think it gives you the clearest, um, I guess the easiest way to talk about it is the height and the size of the volume. So therefore, you can easily tell if I just mark, or even B, if you use this as the weighted average of volume and it's on your chart, you can tell that every single time those explosive moves came in, you had an opposite move come in, and or B, um, looking at it from a lateral perspective, if bears are consistently trying to short yet their volume stays stagnant, price usually takes those bears and rips it to the upside depending on where you are on a daily chart. Um, and kind of explaining it from a perspective of a daily chart, you could kind of understand that if price is shooting up, for example, this March daily run up, and your volume isn't equal, as soon as those bears start stepping in with higher volume than the bears or than the bulls. So when I state that, I mean compare it from April 22nd to March 16th. As soon as that bear volume started coming to the market, either one, bulls are going to try and defend that price, and or B, bears are going to start getting a little bit heavier in relation to volume, and therefore they brought it down even harder and flushed it another 40 points to the downside. So I think you can use it on any major time frame, and I think you can use it on intraday time frames. However, I think 1 minute is the best. Um, but going to continue it, looking at the volume at the bottom, you could see accumulation of specific positions, and you can also notice while positions are working in their favor, as someone was bearish on the market within these clusters, they scaled in, scaled in, scaled in. The volume is relatively stable for bears. Bulls try stepping in on the same pivots and they failed. Bears step in more aggressively, bears step in more aggressively here. But you can notice as we start getting into deeper pockets of the market, and we also know based off of our liquidity pools, aka 387 being our short signal for Friday, that they failed to break it below 387. Volume failed to come in to bring it down below 387. And then we actually had a volume anomaly flushing us through 387. And I remember this is where I went long and other people were still shorting. And I was confused as to why, because I saw this volume anomaly and all we needed to continue breaking us out was more volume than the prior buying. So we had a consolidation, and you could barely tell, but if I mark it, that buying is equal on the bottom. And the short sellers that are coming in once we get up to these prices, they're not as strong. So therefore we continue running to the upside, and we had a decent breakout, and we had short cover it going into the end of the day. But it was a pretty big boom. And if you guys want to ask any questions, could you also touch on how you determine liquidity levels? Yeah, I got you. And if you guys want to participate in the discussion as well, you can head into seminar discussion. This is down at the bottom of the server, education and news, and or be in any of the regular member and or options chats, and I can just scroll through the Discord and find those. But I predetermine these liquidity levels every single day, just based off of my Scout Wick system. So I noticed something, and this is why I recommended people to sign up for that data package up here in the top left, that ARCA package. But I noticed at 8 o'clock every single morning, I would sit there and I'd start planning for the day, and this was like a year and a half ago. And I noticed these candles and how they came into the market, and then from there, price started to then behave in a way that was different than just the regular pre-market trading that everybody was doing. And I noticed that those levels were then used as major levels of liquidity for the session. And so from there, I started practicing with it, and we are going to transition from volume into my next topic, which is fibs, but fibs based around this system in particular. And I just started fiddling with it a little bit more, and I noted that if they leave these wicks here and they never touch them, they use them as future targets. Sometimes it takes 6 months, sometimes it takes 2 years, sometimes it takes 3 years, but they'll leave them, and eventually we come back. And either whether people are discouraged about being in a bear market or not, we have these liquid candles all the way to all-time high on the indexes. So eventually indexes will return to all-time highs, and you should continue buying long term. Um, but they leave these candles once they start major liquidity within the markets. They do this every single morning regardless. And from there, all it is really is just slapping the top of the wick, slapping the bottom of the wick, and then the high and the low of the second one. So there's one at 8 a.m. and there's one at 8:01, and that's all I'm doing. And that's how I determine it. And then from there, let's say you didn't have this, how can you know that these are levels of liquidity? Well, if I zoom in on the 15-minute and I observe, let's talk about 380, we can easily see the amount of buyers that are present and sellers that are present at 380. Well, if we notice that the shorts within position at 382, well, we broke below 382 or above it, price starts exploring more. The next level of liquidity is at 384s, 385s. We break through 385s, we come up, we find the next level of liquidity here. You can see where the sellers were positioned up in this range. We come back down and we backtest the prior levels of buying, which is 385s, and we hold it and we try and push into higher levels of liquidity. So now if you are a bear while we're continuing this uptrend, we have to take out these lower levels of liquidity to then continue lower. And if that price continues to hold, then we test deeper supports, and or B, if this price holds, then we break out. So that's it. And it just depends what time frame you're looking at as well. So I use 15 minute as an example. If you want to use the 1 minute specifically, you would then wait at least, some people wait 30 minutes for an orb to form, which is your opening range break. Your first 15 minutes to 30 minutes of the session, you'll get a high or a low candle, and then from there, price starts pricing in the session and how we can trade. But because of these candles, I noted every single day, mathematically, we are forced to stay within a range. Um, and these candles that show up are the ones that are pricing in the candles every single day. Let's continue. So the next thing I talked about, and I talked about this at the start, is having a plan, right? And that doesn't mean you need to be bearish. That doesn't mean you need to be bullish. That just means that you like where the asset is trading at certain prices and why. So if we look at this, for example, I want to go, well, why are buyers, besides prior liquidity down here in these prices, right? Why are buyers stepping in here based on other conjunctions that we can use? So I'm going to use fibs as an example because I like fibbing a lot and it gives me targets. So I'm going to fib this to this just to start with. And we see a retracement to a very bullish fib level down here. Now, before I even continue adding fib levels to the upside, we can already notice, looking at the session, what happens when we tap this price. And what happens when price gets this low? You have short exhaustion. And this is just one example. I could go through many examples of this. I'd use the system all day long. But we have exhaustion here. And from there, if we delete this and we adjust the way the session traded, so we want to measure to the upside with a trend-based fib extension, all I'm going to do is monitor these 3 points. So 1, 2, 3. And if I turn on my trendline tool, so you can see exactly what I did, all I did was mark those 3 plots. And so from there, we stay and we look at this and we go, okay, now we have this pre-market plan forming for us a little bit. We know that buyers are present here. However, since we're trading in pre-market, or we're not trading in pre-market, we're options traders, we're missing a move, right? We've missed a run up of 1 golden zone, of 2 golden zones. So now it's a lot more high risk going long at open, because we know that if price continues above these pivots right here, It's either A, overextended, or B, and why are we going to say it's overextended? We're going to say it's overextended because of this base. It only gives us one base, because you also touched how you determine liquidity. Oh, whoops, I was reading the same question. um, you can notice that based on the single bottom on live price, we're having a hard time clearing these continuation zones. And I don't even need to fib to show where these continuation zones are, because this is where prior price was in comparison to selling off. So we come back down and we make a double bottom. Now we have a plan in place, right? So we have a risk reward ratio. So we're going to look to long off this pivot. Our target is at least this, if not higher, but we're going to use this as our target and our sell signal. So when we're getting out of the trade is roughly this. So we get a 5-to-1 risk reward ratio, and we don't know how long it's going to take to get this move. That's why we don't trade zeros. You trade at least 3 to 5 expirations out. So if it's a Monday, you buy a Wednesday, a Friday, or you buy a Monday of next week. But from there, we break out, and you can notice just the way we traded after we start clearing these prices. You could see how overextended it started to trade. And why did we consider this overextended again? Well, we have a higher low, but we don't have a double bottom. You could count this if you're valid about it, if you really think that this is going to be considered one. This is not valid just due to the fact it needs to touch relatively that same price, not a 20-cent difference. We come up, we fail the next golden zone, and from that point, we get a retracement. Now, it's very easy to measure these retracements because you're just looking for those golden zones to therefore reject. So I can either apply the retracement here to here or here to here. I'm going to realistically just do the live session. We're going to keep it easy. So from there, we get a flush through our first point of liquidity, right? Bears don't have enough volume to break it through yet at the time, so they come back up. However, there's not enough buyers to come through price, so we break back down and we tap golden zone. However, we've already tapped this pivot once in relation to using it as an uptrend to go higher. So why would buyers want to use that same price to continue pushing us higher? It makes no sense. So from there, they get an aggressive flush after trapping people in longs and rejecting the long signal. So there's another plan within your tools that you have for confirmation. We flush below, we tap our next targets, we tap our next target, and then eventually we dead cat bounce and short cover into close, which I imagine futures are live. No, it's 30 minutes. So we could honestly see futures opening red and opening red on Monday. We could see a flush into a rally again because we know that we need a better supportive move within price to break us out. But from there, the problem with the rally on Friday is this is considered a dead cat bounce. We bounce off this pivot and we lost this price. We don't like the bounce. We want to see this long come up and then reject. Well, the problem is we didn't do that, right? And this is why I say again, use more tools besides just fibs, volume, so on and so forth. Apple was strong while indexes were weak. Apple put in a better retrace, and I'll show that example later, but we rallied. And from there, once we claimed this momentum in this golden zone, it was a matter of telling how far price could go because we also claimed daily pivots. That's what this 0.5 fib is. And from there, we continued rallying, but price had to come back down mathematically, and we couldn't break new highs, and I closed all of my longs within these clusters because it was hard to break this price, and we knew price wasn't going to break. So that's another example of tools I use throughout the session. This is going to be a shameless plug because it's a mix of a couple things, but where are we doing questions? Either here or the seminar discussion or members chat. How do you identify a golden zone? A golden zone is a 0.32, 0.618, 1.272, 1.618, and so on and so forth. So This is both equal within a retracement and an extension. So these are both going to be considered golden zones at either side. So for example, when we use this for as like a retracement for the start of the day, we're measuring what price can do. You notice how price holds this range within strong volume. So this was us holding golden zones in a positive manner. And then from there, if we measure it to the upside, this is us stating, okay, we get through our first one, our target's the second one. We get through the second one, our target's this dead cat pivot. We get through the dead cat pivot, we can realistically ignore this fib set. The one fib set was made by the US and it's not real within mathematics. So we break through that on strong volume, we take out another partial here, we take another partial here, free runners to our next fib set. Pretty easy. I think you and I absolutely, I would love that. I love that. So the next thing I want to show you guys though is oscillators. So I'm gonna use the one that we have within the member side of the room. No, everyone within the call right now is a member besides Swoosh and Andres and Shark Tank. Um, you could still find these tools within TradingView that aren't the Magic Line or our tools. So want if you don't want to make it hard on yourself, you could sign up for that. If you just want to use those memberships, you get what I mean. But I don't really give indicators a lot of love. I usually am one of the people that talk down on indicators, to be honest. Um, but Magic Line and oscillators really shifted my perspective on the way indicators work. No, again, these aren't just one signal to use for longing or shorting. You want to use a bunch of different things as well in conjunction with one another. So what can we notice about this continuing? So let's combine everything we've learned. So we're gonna fib this again, trend-based fib extension to the upside. All right. So looking at this, what can we consider now after using all of our tools? Okay, well, we had a single bottom of live price. You can consider a double bottom if you want. You have exhaustive volume coming into the market, trying to break us through the long signals. We're overextended within a squeezed rally. And so from there, I want you to notice the oscillator at the bottom. What's happening? Well, if you notice from when we started selling off in pre-market, you can kind of see we get this range of where the trend is trading, right? You notice that we come down through it pretty aggressively. We come up, we start dancing, 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 head an overbought period, come back down, find a base for momentum, rally, rally, rally. However, from this point, I want you to notice this within price on the stock. So, boom, we make roughly a bear channel. We have an oscillator break us down to then see continued highs, break us down to continue to see continued highs. But what's happening at the same time is you're having something that I like to call negative breath. And what that means is, imagine, let's just talk about it, like literally within the sentence. It's like someone ate a form of onions, it sucked. Price was continuing to go up in a fashion that we didn't like. There wasn't enough volume to support us. There was enough momentum within price to support us. And so volume came aggressively down. After the oscillator reset, it came back up one more time to retest this prior buying at the highs. It continued to make lower highs within momentum while we were rising. And so from there, we had an aggressive flush to the downside. Now we had the first player step in here because momentum got to that point where it was oversold. But I want to state again, this is why we don't just use these. We want to use a bunch of different tools within our battle, you know? And on top of that, the price action sucks. The volume sucks. We don't like this pivot. So we come down, oscillator then forms a base. You start having wiki price action. You're starting to have less bear volume. And once we break down, we get an explosive move back up because our oscillator has reset fully. Now, what's really interesting to look at when I observe this again, because I just saw this on second glance. So I'm going to delete this one now. We have something that I like to call a positive divergence. And so it's the complete opposite of what we just saw before, right? So, let's see, no questions, okay. So we come up, price finds this low, and our oscillator is putting in a positive divergence. However, it's hinting at something, right? Look at what happens to the players that get out here. It says, oh wait, well, oscillator just dumped, but price didn't dump. Price held. That's interesting. So I wonder if bears just got forced to stop out and cover, and why we covered. Well, momentum was at a higher price than our oscillator was, right? Price was at also a higher point than our oscillator was. So when we came down and we flushed to this point, and also we remembered, if you remembered from the tick part of the video, that we had a flash short signal here and the price continued higher. So what gives? Why did the oscillator have this beautiful positive divergence and then we ended up flushing eventually at the end of the day? Well, the point I'm trying to get at with identifying this is even though we flushed and came down, our prior buying was held. Oscillator held its momentum. And we also put in some form of a higher low at this price again to then continue going higher. So when you draw the intraday fibs, is it based off the scout wick low, close, high, and it's an extension, not a retracement? It depends on what's going on. So and what the price action is following the 8 a.m. candles. And so I can go through and show countless examples so you get an idea. So I'll show that after this. So we have this momentum come in, but bears showed their hand here realistically. And so when we got back to these points where we started getting overbought, all we needed to look for is if you were a bear was a continued trend of selling, a failure of regained strength. So remember when I say that, looking at this horizontal line I just drew right here, price went higher, but momentum didn't. So we came back down and chopped flush into the close. But let me answer that question though. When you draw intraday fibs, it's based off the scout wick, low, high, close, and its extension, not a retracement. So it depends on what we're doing. Most of the time, it is a retracement. So I'll measure this to this, and then I'll wait till price finds a support pre-market to then therefore give my long signals or give my short signals and then the targets out every morning. So for the members that like the member side, my targets aren't until we find a base pre-market. If I do put out a plan beforehand and I'm putting out upside levels and saying where we can hold here and why, you still be a little careful. So I'll provide another example. So looking at this one, right? Our two scout wicks at 8 a.m. stayed exactly the same relative. So all I'm going to do is do a retracement off of that. And if you can look at this and go, okay, if you understand fibs, you go, why did price rally into the open? And we're going to use a bunch of different and why was this a trend day? Why did we continue squeezing while everyone was screaming for this to come down? And this is why I like to review. It's important. We'd look at this again. We held our short signal. The red in this example is being used as a short signal. And we hold a golden zone. So if you remember, I told something lame that a 0.32 and a 0.618 is us holding golden zones. So I'm going to measure that to the upside. 1, 2, 3. That's it. That's all I would do. And so from there, we're trading boom, 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 boom. In the pre-markets, the long signals held. We hold another momentum zone. And then from there, price just shoots up. And we only needed this fib set all day long. You could have looked for a retracement here, but you don't even need to apply a different fib set because we look at that. You can see how accurate it is, and you don't need to shift anything else. This is a gorgeous example of a trend day. Gorgeous, gorgeous example. And this is all you would have needed to do. This is it. And let's say you were looking for this retracement.
That is fantastic.
Yeah.
That's actually fantastic what you just did there.
And
That
if
is
you're
fantastic.
if you need a better bias to understand why this could held as well and why we're continuing to go higher, when bears finally step in for the first time, look at this retracement we get. Oscillator resets fully, bear volume barely picks up in comparison to the prior buying here, and we hold a golden zone, so price just shoots right back up. We sure this guy isn't an MM? It's a great example. Can you show an example of using fib retrace and extension on IDM, wick, and pre-market resistance, specifically in cases where price continues to rally pre-market? I think this is the best example. If you want that, I mean, this is a way to where we see that price continues to hold. We hold the long signal. We never break the short signal. Once long signal's broken pre-market, we backtest momentum. And what a down day, and that's what I wanted to show you guys. What about a chop day? What about a day that sucks ass? We're sitting here wondering what the fuck, like, what are we looking at? How does this help us, right? So let's start. Well, if we know that we're fibbing the two ranges in the morning, so 1 to 2, that doesn't really give us anything, right? It's an unconfirmed signal. We don't know what price is going to do. The only thing we can do is continue to watch here. So maybe let me adjust, and this was the FOMC minutes. So let's kind of sit here and think about it, and we go, well, we put in our first topping pattern here and here. There's nothing on our fib showing us this, but price at the morning continued to hold the short signal and rally. So maybe let's flip it from doing a retracement and let's apply an extension. Let's see what happens to price. 1, 2, 3. Well, that was pretty self-explanatory, right? We continued to hold the short signal, we rallied into momentum, and we failed to clear momentum. And so from there, we'll just measure it to the downside, right? 1 to 2. But the problem is, even though we broke below the short signal, price continued to hold, right? We came up and we put in this weird algorithm that held us. So maybe that short signal isn't valid. I wonder what happens if we do it to the upside. 1 to 2 to 3. And so from there, price just rallied to a point at the end of the day where we weren't really holding any fib sets. We cleared below at a momentum point. We had priced in down moves and price was going parabolic. We hit an uptrend, and at that point we flushed. I want to find an example of a down day though. So this is an example of a down day. And you'll notice these a lot. You'll have price and up moves that are very aggressive to the upside. You'll be 2 to 3 to 4 points away from those signals. But that doesn't mean, again, we won't revisit those signals because you can use these as swing trades. But we sit here, we go, okay, well, price hasn't found a bottom all of pre-market. This liquidity failed to hold. This liquidity is trying to hold after we flush, but it's not finding any buyers to break us above this. So where will we find buyers? So let's measure it. 1, 2. That's it. That's all we did. Right out the gate, we get a flush below golden zone. We chop along it all day long, and then we find the next pivot. But it doesn't give us it accurately. Maybe if we adjust it a little bit, well, that's a little bit more accurate. But we're going to keep it to the rules. So we're going to continue measuring our fib set. We're going to delete this. We're now going to measure to the upside. 1, 2, 3. And again, this is what I want to state, that we don't just use these tools. We use other tools, volume, oscillators, long and short signals within the market that we have at 8 a.m. every morning, and that we leave them manually plotted all day long. So we understand where levels of liquidity are. We come up, form a base, we failed golden zone, come back down, hold the same base, price breaks through, fails this liquidity, back test, and then a stair stepping all day long. That's all it was. Same thing. Let's look at a choppy session. Well, and this is where sometimes the plan's hard and you kind of got to understand a little bit of what you're looking at, and practice sometimes does make perfect. But we come up, we get our weird little algo candles, we hold golden zone. So now let's measure this to the upside. 1, 2, 3. Price continues, we rally, fail momentum, hold momentum, fail golden zones. We're now going to measure this to the downside. So 1 to 2, and that doesn't really help us. Let's move it up. 1 to 2, And remember, we moved it up here. Why? Because this is where we applied the fib set to begin with. And then from there, we find golden zone and we rallied. And that was it. And the short signal held. But yeah, let me, he said my name, I'm basically famous now. Do you monitor X sectors plus VIX in addition to fibs and tick? How do you determine which of these multiple sets of checklist items to consider and which ones to disregard? Is there a priority list to use? You're asking good questions, honestly. And I'm gonna say, one, I don't use VIX. So, I haven't really enjoyed VIX. I think VIX is laggy. Like, short signals will come in on VIX like 3 bars or 3 candles after the fact. So I'm not really a fan of that. So instead of VIX, I use SQQQ. So the reason why I use SQQQ is because it gives me my Scout Wig system at 8 a.m. every morning, and I can better understand the market based off of SQQQ's momentum, the same way I would SPY, Apple, AMD, so on and so forth. Secondly, I will. This is hard because for me personally, I only trade like SPY, Apple, AMD. Like those are my things. I like trading things that move within each other. Um, so to better answer the question, if I was watching Walmart, I would also watch consumer staples. If I was watching AMD, I would watch SMH or Soxel. Um, and the other question you asked is how do I determine which of these multiple sets of items to consider? I will consider these all at the same time. There isn't necessarily a relative priority for me. The only exception I would say for me personally is I would put fibs at the top and the levels of liquidity I draw at 8 a.m. at the top because those are what is pricing in the market every morning. Um, but it doesn't mean that I will ignore the other ones. It's just I won't bias check one of them without back testing the other ones. So, for example, even though SQQQ is bullish on this 1 minute time frame right here, right? And so we get a rally. If I zoom out and I look at the 5 minute, this bounce sucks, on the oscillator, for example. So I don't really want to long it. It's just a higher low and a form of exhaustion that bears are trying to do. Um, so there's a lot of different ones I'll use and why it's not just those. Um, but I'd say all of them within conjunction, but Scott Wicks and Fibs and volume the most. Those are my favorite three. And then something that is kind of underrated, but really you're making sure your tickers that you're trading have liquidity. And so what I mean by that is you're not going to get a clear example of the trend if you're watching Google's volume, because look at this volume isn't really like helping you. Sure, it's still following our same rules, right? But Google literally will gap up and down like $3 to $5. So this won't give you tools to better watch price action. And then same thing with price action. You get $2 to $3 bid and ask on volume bars that are like 1K. So it's like, how can I predetermine volume and price action and all that if the price action. So for expensive stocks like these, I would pay attention to the sectors that they behave in. So like Google with XLC, if we put these side by side, we can kind of get an idea of, okay, XLC was bullish throughout the whole day, and then all of a sudden it put in this rounded formation, and then from there we can identify that, oh yeah, Google can come down with this. I'm not sure if you went this already. Does tick and volume ever show divergences or different signals? Yes, it does. That's why tick specifically won't use volume, because you can't use volume on tick, but Tick will give buy signals or sell signals while you have volume divergences, and that's why you look for areas or potential scenarios of overbought and oversold. Um, and you use it as well within your oscillators and a bunch of other kind of stuff, because apparently indicators work on this too. But um, you know, like remembering that, okay, well, the last time we found resistance was at 739 and on the highs on tick, we need to continue through that to have a buy signal. We break through that, we see 1000s, 1100s, 1100s, and then a back test of that, and then we continue holding. And so this is from 1021 on, right? So we look at SPY from 1021 on, we continued holding, so price just went parabolic. So um, I highly recommend Tick as well. This one is something that I think a lot of people don't use, but if you do use it, it is a very, very, very strong tool in the right ways.